right, so welcome guys. We're recording now. My name is Chris. I run LazyFA.com, and I'm back here again tonight to talk about analyzing 10K reports. So this stream process is something we've been doing for the last few weeks now, and we've got 3 more weeks planned after this. So if this is your first time here, that's who I am. Tonight we're going to talk about analyzing a 10K report, and we're going to use an example of a stock that's been in the news over the last about the last month or so in order to do it. So this is going to be a relatively short presentation, I think, at least in terms of the PowerPoint stuff, but then we'll actually go into the 10K itself and talk about that. So just a couple of quick housekeeping things. If you have questions throughout this webinar, you can use the /question command. Like that, just put in /question in the Discord chat and then a space and then whatever your question is, and that'll get put into the questions channel. Then I can go through them at the end of the night. And that is how you can ask questions. Also, if you're watching on Twitch, you can ask them there too. I can't guarantee that I'll get to those ones only because I'm not watching both Discord and Twitch, but I'll try to get to both of them. So. All right, so let's talk about analyzing a 10K report. So first of all, just let's talk about the audience a little bit. The information that we're going to cover tonight is aimed at more long-term investors. So in the last webinar, we talked about scanning and finding trading ideas. And the one before that, I think we talked about parabolic trades and how to time the market better. So those were both webinars aimed at shorter term traders and day traders and swing traders. But this webinar is going to be aimed at those longer term investors who want to know sort of the inner workings of the companies that they're actually making long-term investments in. But shorter term traders might still find this useful for judging the validity of short-term moves. For example, if you see a stock move upwards a lot really quickly, then knowing a little bit about the inner workings of the company and the management and whether or not they're profitable, that can help you to judge the validity of that move. And then last thing, which I always say in these talks, is just this is not a recommendation to buy or sell anything. I'm not a financial advisor, so just take everything that you hear with a grain of salt, do your own due diligence, and do your own research before you actually go out and buy or sell anything. So that's that. If you don't know what a 10K is the company's annual report. And here's some instructions on how to locate it. So you can find them, there's a few different places you can find 10K reports and other SEC filings. One of them is on the company's website, which is probably the fastest way. But if you're looking for a collection of all of the company's SEC filings, you can always get the originals as they were filed with the SEC at sec.gov. So I'll actually bounce out of this presentation here for a second so that we can look at that. So to actually get to a 10K report, you can go to sec.gov and just click on company filings here in the upper right-hand corner. And it'll be a little bit different on mobile, but you should be able to find it. It's just in the menu. And then once you're here, if you put the ticker into the fast search box, so if you want to look up Apple, for example, just put that in there and click on search. And then these are all of the filing types along the left-hand side here and the format that they're in, and then a description of them and the date they were filed and a couple of filing numbers. So if you want to find 10K or 10Q reports, right, which are the annual or quarterly reports, you can just put in just 10-, and that will find both 10Qs and 10Ks, or you can put in specifically 10K if you're looking for only annual reports. And then I had mentioned here also, you can either click on documents or interactive data in the format column. And so this interactive data is something that they started after 2008, which just makes it a little bit easier to read these things. So the interactive data is nice for analyzing the financial statements, but the raw documents themselves, the actual SEC filings, are in the documents area. And then once you're here, it'll always be the first link at the top, whether you're looking at an 8K or a 10K or whatever other kind of filing. It'll always be the first link is the actual filing. And then this stuff down here is just XML stuff for data manipulation and data parsing. And all of these other links are exhibits like addendums and extra stuff that they had to file along with the SEC filings. So if you click on one, then this is what you're going to get, which is a very, very long document for a large company like Apple. This is what? So this says it's 63 pages, but that's actually 63 pages of the financials. And I believe that maybe it is only 63 pages. These get pretty long, though. They can get to a couple hundred pages in some instances. So, but anyway, that's how you find an SEC filing. So if the documents option is chosen, the filing is always the first file there. Now, what I like to do when I analyze SEC filings, just because this format is like, there's no margins or anything, so it's really hard to read when you have to read like all the way across the screen. It's easy to just lose your place. So you can either make your screen smaller, right? Make your monitor smaller, or what I like to do is actually download them into a PDF. And then you can open them up in a PDF editor and you'll be able to like annotate them and zoom in and out and stuff like that. So this, for me, just makes them a little bit easier to read. And you also have the page numbers and stuff over on the left-hand side, which is nice. So that's what I did with the one that we're going to be looking at tonight. Okay. Before we get to that, though, let's talk a little bit about the structure of a 10K report. So it's broken into 4 different parts. Part 1 is everything that you need to know about the business. So what they do, what their products and services are, what the risks to the business are, who their competition is. There's a portion in here about any unresolved SEC staff comments. So if SEC staff has commented on anything or had questions for them and they haven't resolved those questions, they have to put that into part 1 so that people know that the SEC is questioning them about stuff. Properties, meaning their like office locations and any kind of manufacturing plants and things like that. And then part 1 will also contain any open legal proceedings. So if they're in the midst of a lawsuit or anything like that, that will also be in part 1. Part 2 is mostly information about their securities themselves, right? So about the stock and the warrants that are out there and stock options and things like that. And then you've also got all of the financial statements and the MD&A, which is the management discussion of financial. It stands for management discussion and analysis. It's basically the management's interpretation in their own words of what how the company's doing and what their financial standing is. It is management's discussion and analysis of financial condition and results of operation. So this is an important section which I always read. And then, why does this thing keep going? Control F5. There we go. F5 was just refreshing it. So that's part 2. And then in part 2, they'll also cover their internal reporting controls and accounting procedures and things like that. Part 3 is information about the directors and the executives of the company. So the CEO, the CFO, all of their management, what their compensation is, any relationships that they have with other companies and other managers, and then also any kind of ownership that they have in the company or in any related companies, and any transactions that they've made which might be material to the company. So that's part 3, and then part 4 is the exhibit index and all the addendums and the required supplementary data. So that's all of the extra stuff, like if they have credit agreements or like extra documentation or anything like legal that needs to be included, any kind of legal documentation or proxy statements or basically anything extra that's not really part of the 10K report itself, but is referenced within it. They have to include those as well as exhibits. So what I wanted to do this evening is actually download and analyze a 10K report. And I figured what better company to analyze than this Genius International Brands, which has been just completely ridiculous over the last week or so. If you look at a chart of this thing, it went from about 30 cents back in the beginning of May to now it hit $12 and it has crashed back down to around $6 a share now. So whenever I see something like this, I always get curious about whether or not this company is actually worth anything and what caused this gigantic explosion from 30 cents up to a high of almost $12, because that obviously is a humongous move. There's lots of people that are involved in this stock now, and there's probably a lot of them that are bag holding it from up in the high 11s. And the question that's on everybody's mind is this company really worth anything, or is it just a big flaming bag of dog poo? So that's what we're hopefully going to start answering tonight. We definitely won't get to all of it, but I did download the 10K report and I gave it a quick read. I didn't read all of it word for word, but I did skim it. And this is what I found. So I wanted to just break this into a few different pieces. It's just some basic information about the company, what content they produce, and then the risks that they face. So if you're not familiar with Genius, I was not familiar with this company before yesterday. So I've never traded this company before. I don't really know what they do. So this is my first foray into trying to understand who they are and what they're about. The business was founded in 2006, and they have this sort of, their claim to fame is that they're a media or branding company that produces this, quote, content with a purpose. So they produce and license media content like TV shows, music, videos, and educational songs and books and stuff like that. And they have branded products and toys that they sell in retail outlets for toddlers and up to tweens. So it's content for children. They do have, in reading this 10K, I realized that this company likes to name drop a lot. But they don't really share a lot of detail about these relationships, but they do have partnerships and licensing agreements with a bunch of different well-known names like Amazon and Netflix and YouTube, and there's a few other ones in there. I think Sling is in there, Dish Network, and they have a big licensing deal with Comcast. So they do have some interesting partnerships, but they don't disclose much detail about those partnerships. So that was one of the questions that I would want to know more about. And then in terms of their content, they produce content in partnership with some pretty well-known writers and directors. I think the main writer of Frozen and The Lion King and SpongeBob SquarePants, so there's some pretty well-known children's programs and cartoons and stuff like that are they're working with the same people, and so that's all good. And their core content, right, that everybody right now is focused on are these two programs that they have called Baby Genius and Kid Genius. And so Baby Genius is this catalog of songs and music videos and educational toys and things like that are used for toddlers and preschoolers. And they, again, their claim to fame, right, is that all of the content they produce is content with a purpose. It's appropriate for kids, and they focus really, really strongly on making sure that everything they do is appropriate for the age groups that they're marketing it to. So it's not supposed to have any kind of innuendos or racism or anything like that in it. It's supposed to be pure. So that's what Baby Genius is. And then Kid Genius is similar, but they market for children ages 6 to 11. And now, the thing that has sort of kicked off this big move recently is they are talking about merging these two Baby Genius and Kid Genius things together into a new program, a new rebranded program called the Cartoon Channel, and that's supposed to be launching on June 15th, which I think everybody is speculating that, you know, it's going to become the next Cartoon Network, or it's going to become the next Nickelodeon or whatever. You know, that's one of the big reasons that the stock is moving so much. The other program that they have is called Llama Llama, and this is actually owned by Penguin. Penguin owns the rights to it, but Genius is the licensing agent for them. So they are using their licensing network to basically spam Llama Llama as many places as they can get it, and they're obviously getting some kind of a cut from doing that. So that covers sort of their core content. And then before we get into looking at the actual SEC filing, I wanted to just talk a little bit about their risks that they face. After reading through the filing, the biggest risk that they face right now is that they just have basically no money. So they're really struggling financially. They have never made any money ever since their inception. They have revenue, but they've always posted net losses ever since their inception, and they disclose that in the filing. So they, as recently as when this SEC filing was filed, which was, I think, just back in like March. Where was it? Yeah, so March 29th was like I think that's the end of their reporting period. But as recently as the end of March, they were basically bankrupt and they needed additional financing in order to continue operations. So their biggest risk right now, their biggest struggle is money. But they do also face some other risks. They didn't have any kind of idea, at least that I could glean from reading their filing. They don't have really any idea how COVID-19 is going to impact their profitability or lack thereof. And they also are pretty small. So they're competing with these big, large players like Disney and Nickelodeon and PBS. And these companies have, way more resources that they can use in order to take retail space from them if, they're trying to sell their licensing, their branded products. These other companies just have so many more resources available to them because they're so much bigger. So they do face really intense competition in this space. Because of the issue of not really having any money, one of the ways that they've been alleviating that issue is selling additional stock and selling new debt. So the management and the debt holders, they have the potential to convert a large number of warrants and convertible notes and options into shares of stock, which they can then dump into the market. So there's a lot of dilution risk in this company. And they also, because they were until recently a penny stock, they were out of compliance with the NASDAQ listing requirements, which require them to stay above $1 per share. So that gives them an incentive to not only manipulate the stock in order to push it higher, but also to reverse split it, which again, basically if you're holding 1,000 shares and they reverse split it, you're now holding 100 shares and they're worth 1/10 of what they were, or they're worth 10 times what they were, right? So you have less shares, but they're worth more. But then you can lose all the way down to zero all over again. And so with companies that reverse split often, you will see, let's look at like, all of these are gone. Maybe Tops. So if you zoom out on a company like Top Ships that reverse splits a lot, you'll see that it looks like at one point back in August of 2016, it was $300 something thousand a share, $3 million a share. I don't even know how many zeros are there, but obviously it was never that expensive. But because it's been reverse split so many times, it goes down to almost zero. They fall out of compliance with the listing requirements, and so they reverse split it back up to $10, and then it goes back down to zero again. And they fall out of compliance with the listing requirements, they reverse split it, goes back up to $10 or whatever, and then it falls again. So over the course of multiple years, you end up with a chart that looks like it was at one point $3 million a share or $30 million a share, and now it's worth 75 cents. Genius Brands is at risk of falling into that sort of situation. All right, so that is pretty much it for the slides. Let's talk about where I got this information. And like I said at the beginning, if you have questions about this stuff as we're going through it, feel free to put them in the questions channel, and I will get to them at the end of the night. But let's look at the actual 10K report. So this is the report that I downloaded. This is the 2019 10K. So if we go to the SEC site, and once again, you can just go to company filings, type in GNUS, and then it's actually right here. So that's the most recent one. It was filed on March 30th of 2020. But if you're looking for just those, just type in 10K there, and then you can hit Documents, and then all I did is just download this file. Now, it's worth noting, by the way, that this was filed in March, so some of this information that I've dug up is going to be out of date because they filed they filed their quarterly report in mid to late May. And then they've also got a bunch of these 8K reports, which are just current material events. So there has been a lot of news recently that's come out. They've done another registration statement, so they've sold some more shares or set up to sell some more shares. So there is a lot of information that we're not covering here, but because this was a talk about how to analyze 10K reports, this was the earliest one. So that's why we're using this. But if you are, interested in learning the most up-to-date information about this company, you should read their 10Q, and then you should also read all of these 8Ks and probably this S3 as well. So that's where this came from. And I went through and added a bunch of highlights to it. The first thing that I do whenever I look at a 10K report is on usually one of the first couple of pages, you'll be able to find how many shares are outstanding. And that's just so that I can get an idea of what their market cap is by multiplying the shares outstanding by the share price. And that way I can judge, how many, like what the market cap is relative to how much money they make. It kind of gives you an idea of how they're valued right now. And also on the front page, there will be, the company's address and phone number and the size of the company, whether they're an accelerated or large accelerated filer. In this case, they are neither because it's a small company. But I always check how many shares are outstanding. And so this is now section 1, the business. So you can see, by the way, if we look at the table of contents here, it's all broken out into part 1, 2, 3, and 4 that we talked about earlier. So it's pretty easy to find what you're looking for. So I always start with the business and the risk factors just because I want to understand what this company does, who they are, how long they've been around, and what the risks that they believe they face are. So starting with the business, this gives you an overview of what the company is. And so they distribute their content in all formats. So they create and license multimedia content, and then they also act as a licensing agent for Penguin Young readers who own the rights to this Llama Llama show and any products that are associated with it. They also own and produce some original content, and they have like 6 or 8 different series and shows that they are associated with or that they've created themselves. One of them is called Rainbow Rangers, and for this one they have a partnership with Mattel as their primary toy partner for this series, and then Viacom had Nickelodeon Jr. had licensed the series for broadcast in the U.S. And again, that was as of December of 2019, right? So this is as of the end of last year, because this is their annual report. So this might have changed since then. But so this is their content that's in production, and then they've got some content that is in development still, this thing called Superhero Kindergarten, and then the Baby Genius and the other released content that they've already got. And then they talk a little bit about the Genius Brands network, and this is where the Kid Genius cartoon channel comes in. So they launched this in September on Amazon Prime, and this is a subscription service that they sell for $3.99 a month to supposedly, right, up to 100 million US Amazon Prime members. Who knows how many of them are actually paying for it? There's probably more information about that further into the report. Which annotation is this? So this is on page 7. All right, so let's go to the next one. So page 8. Let's see. So what I've done here, by the way, is just gone through and highlighted the stuff that I thought was significant as I was reading through this. So like this is kind of significant, right? Products bearing our mark can be found in a wide variety of retail distribution outlets, reaching consumers in retailers such as Walmart, Target, Barnes & Noble, Home Depot, Amazon, Old Navy. And they often negotiate dedicated retail space that includes branded signage to give our brands prominence and clear communication with the customer. I don't know about you guys, but I've never seen anything in Walmart or Target with Genius Brands International plastered all over it, but maybe that's just because I'm not often shopping in the toy section. But, this is sort of significant. So that's what I did with these highlights, is just kind of anything that seemed interesting to me that I felt was worthy of taking notes on. This is why I like to use PDFs, because then you can just go through and add your annotations and highlight things and come back to it later and sort of skim and just look for your highlighted notes. Again, to compete, they focus on their strategic positioning of content with a purpose, which they believe is a point of differentiation embraced by the industry, as well as parents and educators. So, their idea with this is that they're producing content that is more pure, and so that's a point of differentiation for them. Okay. So this was one of the concerns that I had as I was reading this. In 2019, 2 customers accounted for 65% of our revenue from the delivery of Llama Llama to Season 2, Llama Llama Season 2 to Netflix, and Rainbow Rangers to Nick Jr. So Netflix and Nick Jr. are making up 65% of their revenue. At least that's how it was as of 2019. So that's always a risk that I want to be aware of. I believe that's changed since then, right? Because they're saying here, as of the same date, we licensed our content to 44 broadcasters in 90 territories. So they might have diversified a little bit at this point, but that's just something that you want to be aware of if they have sort of all their eggs in one basket. Here's a list of the websites that they maintain also. So they've got a few different websites. Incorporated in California in January of 2006. And then we get into the risk factors. So this is where I found that they don't really know how the coronavirus pandemic is going to impact them. It says here, the company's management cannot at this point estimate the impact of the outbreak, and no provision for this outbreak is reflected in the accompanying financial statements. So they really just haven't really said anything about it. So that's a question, that you might need to answer yourself. We have a history of operating losses and have incurred net losses in each fiscal quarter since our inception. So they have never made money. They'll need additional financing to continue our operations. As of December, they had $305K in the bank, and they had said that that was not enough by any means to continue their operations. So they were forced to do a secondary offering where they sold more stock. And that is, again, the biggest concern for me. They just have, they're struggling to stay afloat without selling more stock, which is, that's no good. So a couple of words here about their competition. So all of the risk factors, right, are broken into just bolded headers here. So we face competition from a variety of retailers that sell similar merchandise and have better resources than we do. And some of these are boilerplate. And the ones that I've highlighted are things that I feel is specific to them. For example, changes in the United States, global or regional economic conditions could adversely affect the profitability of our business. Well, no shit, right? That could happen to any business. So there's nothing really significant about that risk. That's just sort of a given, in my opinion. Inaccurately anticipating changes and trends in popular culture could negatively affect our sales. Duh. So some of these things are just kind of boilerplate, but as you go through these risks, you want to look out for the ones that are specific to that business and, are really focused on them and not just sort of generic, well, if the shit hits the fan, we might lose money, because that's going to affect every business the same. So that was another one, specifically about the competition. This one here was interesting to me too. I don't know if this is generic or not, but they have said that they would be required to pay significant penalties if we're not able to meet their obligations under the outstanding registration rights agreements. So I would want to know, before investing in something like this long term, what are the outstanding registration rights agreements? Where can I find them? I want to read them so that I understand what their obligations are, so I know whether or not they are able to meet them. Because if not, supposedly they'll have to pay a lot of penalties. So that's something that needs to be looked into. Another risk that I saw as key for this particular company is that their management currently owns a substantial interest in our voting stock. They said that they own about 11.24% of our shares currently outstanding. And this might be either a good thing or a bad thing, right? Because it shows that management has a vested interest in the stock price performing well, but it could also indicate that management has an incentive to manipulate the stock price in order to benefit themselves. Or it could indicate that they have the ability to just dump all their stock and cash out on the backs of retail investors. So this is just something that is, you probably want to look into the management team and make a judgment call as to what this risk really means. Okay, so risks related to our common stock. A substantial number of our shares may be issued pursuant to the terms of the 2020 convertible notes. So this 2020 convertible notes terminology, 2020 convertible notes. Don't know why this is not showing me the total results, but there were like 200 occurrences of this. So these notes are significant. So before I made any kind of decision about a stock like this, I want to know what the terms are for this debt and how much it is and what the stipulations are and what the covenants are in order for them to not default on it. So this is something that would probably be filed like along with the 10K in one of those exhibits, but it's not often going to be listed in the 10K. There might be some details about it, but this is probably going to have like its own 30 or 40 page document with all the terms and conditions. But that is something that I would want to look at. There is a cash burn covenant in those 2020 notes, which means they have to maintain a certain level of cash burn, or they have to maintain above a certain level of cash burn. So if they start burning too much cash, then they could be in default on this debt. So that is, potentially an issue for a company that is young and growing. Well, not really young, but definitely growing and living off of debt. They're going to burn a lot of cash. So you want to know what those covenants really are. And again, that just goes back to, reading the terms and conditions of those notes. So this is all stuff in the risk factors section. What was this one? So this is what I pointed out in the risk slide here about the reverse split risk. They had said this was about receiving notification from NASDAQ that they were out of compliance, and then they got an additional 180-day compliance period until August 31st, based on their provision of a written notice of our intention to cure the deficiency during the second compliance period. So basically, they had to get their stock price above $1 a share for more than 10 days in a row by August 31st, 2020. But the key thing here is that they said, including effecting a reverse stock split if necessary. So until August, if this company drops back below, let's get it back up here on TradingView. If this company drops back below $1 and stays there for more than 30 days, then they'll be out of compliance again. So imagine, if you will, that from this point, it's just a bloodbath and Genius Brands goes way back down to 75 cents and sits there from July until August. They will then be out of compliance with the NASDAQ listing requirements until by August 31st, they get their stock back above $1 for at least 10 days. And if they can't do that, then they will be delisted from the exchange and they won't be able to have their stock trade on the NASDAQ anymore. So one of the ways that companies will avoid that is if it's getting close to that compliance period and they can't extend it because they've already extended it once, then they'll do a reverse stock split in order to push the stock from, say, $7 or from 75 cents to $7.50, right? So they do like a 10-for-1 split or a 1-for-10 reverse split in order to consolidate the shares, push the stock up to $7.50, but it's really worth the same amount, and then it can go all the way back down to zero again. So again, that's how you run into situations like Top Ships, and there were some other ones in the shipping sector like Dry Ships, DRYS, which is since gone. GBSN, Great Basin Scientific, which is also gone. They all had this sort of toxic dilution reverse split shenanigans going on for years and years and years. And that's definitely something that you want to pay attention to. Okay. So we're not going to have time to get through all of this stuff, obviously, but hopefully this gives you at least some idea of how to analyze these reports. Obviously, it's a lot of reading, but if you look at the table of contents, like I said, it's relatively straightforward. The key parts that I usually pay attention to are the business and risk factors, especially legal proceedings. I like to know if they're in the midst of any lawsuits. This company doesn't have any, so that's a good sign. Mine safety disclosures are only for mining companies, so that obviously is not applicable here. But the business and risk factors I always read. The legal proceedings I always check. The MD&A, always read the MD&A. And then I like to know a little bit about the directors and the corporate governance. So their executives, how much money they make, what their compensation is, and so on. And then the financial statements, the real important thing to read in the financial statements is not necessarily the financial statements themselves. That's useful information. But what's really important is the notes to the financial statements. So you'll notice the actual filing itself is only about 40 pages long. But then once you get through the exhibit index and the signature page, then you have another, so there's like F1 stands for financial 1, so financials page 1. Then there's another like 40 or 50 pages of just information about the financial statements. So what's really important to read in these financial statements is the notes to them. So the notes to consolidated financial statements, because just looking at the balance sheet and the income statement and the cash flow statement, that's all great. But in order to really get a good understanding of what that stuff means and what some of the like opaque language might be, what it might represent, you've got to read the notes to the financial statement. So all the footnotes, that's where all the good stuff is. And that's where I found in this is one of the things I always look for, is this phrase, ability to continue as a going concern. So as of December 31st, the company had cash of $305K, which is not sufficient to fund the company's planned operations and production through 1 year after the date of the financial statement. So basically, if they didn't raise capital, they were dead in less than a year. This phrase, there is substantial doubt about the company's ability to continue as a going concern, is basically accounting lawyer speak for, we don't think we're going to be able to survive. So that is a phrase that I always watch out for in these financial statements. And if you see that, you should definitely dig deeper before making any kind of big investment or any kind of investment at all. One of the other things I found interesting here is, I made a note somewhere, I don't remember which page it was on, but it's also here in the financial statement notes. They changed their revenue recognition policy recently to adopt this new accounting standard, ASC 606. And this is something that a lot of companies do, but anytime there is a change in revenue recognition or expensing policies, that always raises a red flag to me, because a lot of times companies will change their revenue recognition or expensing policies in order to manipulate their earnings. So whenever I see a company that has recently changed their revenue recognition policy, I always want to know why. And then I always go back and look at the numbers as if they hadn't changed their revenue recognition or whatever policy we're talking about. I always go back and run the numbers as if they hadn't done that, and see what it would look like if they had if you undo that change. Because sometimes people will use this companies will use this as a way to cover up underlying problems. So that's always something to watch out for as well. Well, those are the things that I look for when analyzing a 10K report, and on average, I might spend a few days kind of perusing these things and digging through them. I've gotten to this point where I don't really read them all word for word, because there is a lot of stuff that is sort of boilerplate and just legal gobbledygook. But I always pay attention to the notes to the financial statements. I pay close attention to the risk factors and the legal proceedings, and especially to the management discussion and analysis of financial condition, because that stuff that's where the meat of these reports are. So that is pretty much it. And I don't know if I mentioned this, but the 10Q is basically the same thing, except it's only for 1 quarter instead of for the entire year. So it's much shorter. This one's only 40 something pages long versus 80 or 90 for the other one. So the first, second, and third will always be, the first, second, and third filings will always be quarterlies, and then the fourth quarter will be included with the 10K. That's the annual report. So, all right, that is it. So would I buy Genius Brands International? No. But would I trade it? Probably. I would not throw my life savings into this. The thing that actually is driving this right now is the launch of the new cartoon, the kids cartoon network or whatever they're calling it. That's what's really driving it. They hired a couple of like big name execs from, one of them was from, I think, Fox Kids, and the other one was from Disney or something like that. Let me look at FinViz. So GNUS. It was back in early May. And then there was a letter to shareholders just recently. I think it was this one. Yes. So Margaret Lech was the founding president and CEO of the Fox Kids Network. And then David Newman was the former president of Walt Disney Television. So, you know, they've hired some big names to help them drive this project. So, you know, it's going to be interesting to see where this goes, but they just are struggling so much financially that right now, for me, it's not really feasible to look at this for a long-term investment. There was also just recently a short report by Hindenburg Research, which is a research firm that I follow on some stuff, and they did a nice report about why this is supposed to be a $1.50 stock within a month. And if you're not familiar with these guys, maybe give this a read as well, just to sort of see the other side of the coin. So that's it for tonight. That's how I analyze 10K reports. And this is always something that I do as the start of my research, definitely not the be-all, end-all of my research, but it's something that if I'm going to make a long-term investment, I always read the 10K and try to get an understanding of who this company is, what they do, what their risks are, and what kind of financial situation they're in before I go any further. And then I start, once I know if it's even worth looking into, then I'll go into more detail and really dig into the other filings and look at their financials and do projections and so on. So that's that. Guys, if anyone has questions, feel free to fire them away now into the questions channel, and I'm going to pull those up on my screen and we'll get to them right now. Also, there's some questions in the Twitch stream as well, so I'll get to those as well. First question, will the live stream be posted online? Yes, it will. I will upload it to YouTube. It'll be in the archived streams channel right here, or you can just go to youtube.com/LazyFA, and it'll be there. All right, question number 2. Do you recommend doing a 10K analysis for any stock you're considering to buy? No, not for any stock that I'm considering to buy. So 10K analysis is something I do, number one, for long-term investments. So if I'm going to make a long-term investment in something, I always want to read the 10K and understand, like I said, who the company is and what they do and what their risks are and so on. So I'll do that for all long-term investments before I make any kind of a significant investment. For short-term trading, it's more something I do out of curiosity. Like for Genius Brands here, we've been looking at these guys. We now know that they are effectively bankrupt without diluting the stock a ton. So that's, to me, that's enough to stop me from making a long-term investment in it, at least right now. And it's also good to know just because, maybe there was a reason that this stock was 30 cents a month ago. Maybe it's because they were basically dead in the water, and now this is just a big pump job. And, we know how a lot of those end. So it's just something that's good to know. And yeah, second question, can you recap what you think is the biggest reason for the sharp increase in the value? So there's the easiest way that I've found to find that is by looking at the date of these big increases. So the first one was May 6th, 2020, where it went from, let's just zoom in here a little bit. So it went from about 35 cents up to 61 cents, and then it settled around 50. So that was a huge move that day, right? 52.68% is showing in the top here. So it was about a 52% gain, and at one point during the day it was up probably about 100%. And that was on May 6th. So then what I'll do is go back onto FinViz and just scroll down and find May 6th. And we can see that the main reason for that push was their announcement that they were going to launch the cartoon channel. And that's this PR right here. So this is what initially caused the spike. And then I just repeat the same process for, each of the other big dates. And if I can't find it, then one of the good ways to find this information is to just go to Google and if I search for GNUS and then go to the News tab and go to Tools, and then you can set it on a custom range. So let's see if we can find like another spike back in the day, or let's look for another company. So just give you a quick example here, just because I know this company is very volatile. So if we wanted to find out what caused this big spike on July 10th, 2014, what was the reason for this move from $3.26 up to $10? What I do is go to Google and I type in the ticker, and then I go onto the News tab, go to Tools, Custom Range, and the range was July 10th. So I would go from like 7/9/2014 to 7/11/2014 and hit go. And you'll find the PRs that were out there that day. So March 21st, entered into definitive agreements relating to a private placement of $2 million principal, blah, blah, blah. So who knows what the hell that means, but that's what originally caused it. So that's a good way to find the reason for these big moves on any date. Okay, so that's all the questions in here for now. Let's jump over to Twitch. I'm going to move this onto my other screen so I don't create Twitch inception. Let's see here. Someone says they're not sold on this company. Yeah, me either. And someone else says, kids love Llama Llama. Never even heard of that before. Why are they choosing to release their earnings one day after the release of the cartoon channel? iBerg34. Good question. I don't know, but that's an interesting observation. I also found it interesting that actually, I guess it wasn't. Originally, I thought that they had issued that PR about the cartoon channel like right before they were about to be delisted for non-compliance on the NASDAQ. But actually, now that I'm thinking about it, it was about a couple of months after. It was just the same day. But anyway, share price has closed over $10 for more than 10 consecutive trading days. Yes, Abyss, you're correct. So one of the people was saying that they have closed over $1 a share for more than 10 consecutive trading days now, so they have regained compliance. But that doesn't mean that they can't lose it again. If it drops back below $1 and stays there for 30 days, they'll be out of compliance again. One person here is asking, can someone explain a reverse stock split? Yeah, so the way it works is, let's say you have 1,000 shares of a company and they're worth $1 per share. What the company would do is split your 1,000 shares, say 1 for 10. So instead of having 1,000 shares at $1 per share, you would have 100 shares at $10 per share. And the effect is to increase the stock price but reduce the number of shares in the market. And it doesn't change the value of the company at all, but it can alleviate issues with not being able to meet listing requirements, right? If the stock is under $1 per share and they do a reverse 1 for 10 split, they can pop it up 1,000% and not change the value of the company at all. So it's not really a manipulation tactic. Sometimes it can be done for good reasons, but reverse splits are not usually a good thing in my experience. Change revenue recognition. Yes. First red flag. And so one person asked, how do you find out about these really small stocks? One way is by looking at the top gainers and losers list on FinViz. That's something we talked about actually just last week. Right on the homepage of FinViz, you'll have these top gainers. It's always the little turd box companies that end up on this list. So this is how I find out about them. Look at Val, some UK oil and drilling company, ran from, looks like about 25 to $1, 162%. So there were some big rips in oil, it looks like. But yeah, this is how I find them. And I've got some other scanning tools that I use as well. All right. Last question was, what do you think the move is for GNUS tomorrow? This is a company where I would just be watching. I would only be day trading this, really. For me, it's not even a swing trade stock because all it takes is one bad PR and they're back to $2 a share. So for me, this is just a day trade stock. I would watch it first thing in the morning, and I would wait for a setup on the 5-minute or the 1-minute chart. And if it provides a good low risk opportunity, then you might take a day trade on it. But other than that, I wouldn't be touching this personally. All right, so that is all the questions that there are tonight. And we are at just about an hour, so that's about what we usually get to. Anything else before we take off? Cheers. The answer to your question, what does out of compliance mean? So the NASDAQ and the New York Stock Exchange have listing requirements that companies have to meet in order to stay listed on their exchange. And if they do not meet those requirements, for example, if Genius Brands stays under $1 per share for more than 30 days, then it can be delisted from the stock exchange and not allowed to trade there anymore. So it would go to the OTC, over-the-counter bulletin board exchange, which is much less liquidity, and there's a lot more shenanigans that go on, and they have different reporting requirements. So to be listed on these big exchanges like the NASDAQ and the New York Stock Exchange and the Toronto and London, there are listing requirements, and when you are not meeting them, you're out of compliance. Cool. All right, guys. Well, thanks again for coming, as always. It's always a good time getting together to talk about this stuff. In the upcoming chats, if you have not seen it, we have the votes out there, the options for the next 3 streams. There's one about discounted cash flow analysis, one about reading Form 4 filings, which are for insider transactions, and then one which is currently winning with 35 eggplants, which looks like we might be doing this one next week, on using Python and market data APIs to build trading applications. So I might have to throw something together quickly to demonstrate how to do that for any of you geeks out there like me. So if you haven't seen those yet and you want to vote on them, vote on which one we should do next week. And what I'll do is, like, in the order that in the order of the votes they receive, I'll do them over the next 3 weeks in whatever order they come up in. So I'll leave that open until we announce the next one, which will be like next Friday. So, all right. Well, that's it, guys. Thanks very much for coming, and I will see you next time.